So it's always like a difficult question to ask, like, what is the best risk adjusted return strategy, right? Because we don't know like the price action. Stuff like Ethereum has been pretty much flat for like the last 4 years or so, right? Since like the last cycle, there was a lot of hype around NFTs and Ethereum was getting a lot of use. But this cycle around on Ethereum side of things is pretty quiet, right? But Ethereum still got some like the major catalysts like the ETFs and stuff like that. So one of the best risk adjusted return was just a simple like E to USDT range from like, $5,000 to like $1,000. And if you just kind of sat tight in that range, you would have been way better off than just buying and holding in a lot of cases, right? And it's even better if you got into that strategy at the bottom of the bear market, simply because if you're deploying US dollar, then you're going to get more capital gains from the divergence loss, right? But in my opinion, it depends on a couple things on like how you should be developing your own strategy. And like my strategy could be completely different from yours, right? Because our goals could be different. Our cost basis is different. Our market outlook could be different. So it's typically a good idea to not like copy my strategy one-to-one or like even my client portfolio that I help manage, because you don't know like what access we have to like, for example, outside funds or like outside cash flow and like what your plan is with your personal investment portfolio, right? So one of the more helpful question I think is to ask yourself, like, are you trying to be a net accumulator of assets or are you trying to be a net seller of assets? And it could depend on like a few things. For example, if you are much less focused on short-term profits, like if you're not really trying to actively invest in the market, you're not trying to like find like different altcoins to invest in and stuff like that, or trying to like take the swing up and down all the time, then you might be better off just doing a more passive like accumulation strategy, right? If your ultimate goal is to accumulate assets that rise in value over time, typically we want to stay long, net long in the market most of the time, and then not be too heavy into stable coins, right? Of course, if prices go up and then like you're in profit, it does make sense to secure some profits, because a lot of altcoins, this is especially true for altcoins, is that like a lot of the profit taking opportunity would come and then go pretty rapidly, right? As we see with Ethereum, it kind of stays above 4,000 for like 1 to 2 months. And then now we're below at $3,000. So it does make sense to take profits more aggressively. But in terms of like total assets on stuff like Bitcoin and maybe your longer term Ethereum exposure, your goal of selling in a lot of cases is to reaccumulate more assets when prices retrace, right? But of course, we cannot time the market perfectly, or we can't tell if, like, for example, Ethereum is going to break out or not, because it only takes like a few catalysts for the price to kind of like move up and break through the resistance, right? But if you're trying to net accumulate over the next like 5 to 10 years, then we want to focus on building up exposure. A lot of times our goal, again, when taking profits, is to be able to reaccumulate these assets at each price, excuse me. And then if you've entered the market recently or have a longer time investment time horizon, which is typically the better thing to do, like it's very hard to make a lot of profit in the next like 6 to 12 months, right? Because sometimes the market just does not play well with your overall strategy. Like if you have a net long strategy, but the market is kind of like just drifting down slightly or drifting down pretty aggressively, then your strategy is not going to do that well, right? But over the long period of time, if you're yield farming these assets, we typically want to bet on assets that have a brighter future rather than assets that maybe have a short-term catalyst, but then you're not like 100% sure what that catalyst is going to do to price action either, right? Even if you're a long-term accumulator, it's a good idea to have a mix of short-term strategies as well, especially if you're investing into altcoins. Because you can't just, with altcoins, I don't think it's a viable strategy to just say like, hey, price dips, just keep DCAing into the altcoins no matter what. Because there's like a bunch of projects that we see like from the last cycle that is no longer around here today, right? Stuff like Solana and BNB, they're actually outliers from like a bunch of these altcoins, stuff like Litecoin and stuff like that. They're no longer that relevant today. And then a lot of the founders would pass it off as like, we tried our best, or it was a fun experiment. I believe that's what the Litecoin like founder was. But during that time, it was pretty much showed as like the silver of the cryptocurrency assets, right? So for altcoins, in my opinion, you have to be more aggressive if the profit opportunity comes, right? And then you typically, again, want to be always net long, simply because you don't want to be in the situation where you try to time the market top and then you're miss out and then have to rebuy higher, right? Especially if you believe in the underlying asset. Like if you're a believer in Ethereum, but let's say you decide to sell at $4,000 all of your Ethereum, but what if Ethereum for some reason goes up to like $8,000, right? And then let's say it maybe draws another dip to like $5,000. Now you're in a difficult situation. Like, hey, should I rebuy higher, or should I, try to wait for another crash? And then maybe that crash never comes, right? So this is the case with assets like Bitcoin, especially when it's like getting a lot of adoption and that people are just accumulating Bitcoin over time. There's a lot of people that just keep stacking Bitcoin no matter what. So do I want to actually sell at like, let's say 120K, all of my holdings? That's typically not a way to go, right? If you want to sell, it's typically a good idea to like take a bit of profit off the table, but you're still net long in the process, unless again, you're trying to like exit this market entirely and then maybe like put your investment somewhere else, right? And then if you're like a net seller, you could be someone that is like more focused on making a short-term profit from the market. You could be a trader. A lot of traders just swing trade and then they hold a bunch of like, let's say stable coins on different centralized exchanges or like different perp dexes like Hyperliquid. When opportunity comes, you take that swing trade and then you exit into stable coins. So in that instance, you're trying to like extract as much money as possible out from the market, right? And if you're like an active investor, typically again, for altcoins, if you're actively investing, it's a great idea to take profits when the opportunity comes, right? Even stuff like, for example, Pudgy Penguins, Pengu, you can see it launched at a pretty high valuation, dropped quite aggressively. If you were accumulating here, it makes sense to sell some at like a specific price target or to dollar cost average out, right? Rather than like, okay, I'm accumulating this asset for the next decade or so, because a lot of things can change in the next like couple years that we are investing in crypto, right? Technology changes fast and you still want to like bet on good teams that have a chance to like dominate the market, right? But if you're like a long-time investor as well, who are looking to diversify your investment holdings, I would consider myself like more of a net seller in a lot of cases, in a lot of assets, because I've been holding on to these assets for a long time. And then my TradFi portfolio, I have some exposure, but I would like to increase the exposure of my TradFi portfolio, right? So my goal for altcoins specifically is not really to be like a net accumulator, right? But let's say like you're heavily into Bitcoin and then maybe you look at some investment in the altcoin market and then you find that like you're willing to take that risk, then you're actually focusing more on being like a net accumulator in that case. Like for example, if you're heavy in Bitcoin, but then you want to like take a bet on like Ethereum and Solana as well, then our strategies could be quite different. But for me, I'm a net seller in a lot of cases for altcoins, but then I'm also net accumulating Bitcoin and maybe some Ethereum over time as well, right? Mainly Bitcoin, simply because I already have a pretty decent exposure to Ethereum. There's a lot of strategies that you could do when you're trying to make like shorter term profits for altcoins. You could like dial up the risk and dial down the risk, kind of what I've been teaching in the course, where like, okay, if prices are really cheap, then it makes sense to be like looking for different crypto to crypto pair opportunities, right? If you're deploying stable coins or if you're deploying Ethereum, then it makes sense to look for altcoins that have solid fundamentals and stuff like a good team and then like the potential to grow and stuff like that. Then you try to get in at a good like alt to ETH entry, right? And then you want to focus on like de-risking your fees into other investment. That's what I'm currently doing with a lot of my altcoin pairs as well, because I'm pretty heavy in altcoins. I'm selling a lot of my fees into either Bitcoin or stable coins, or later on, if altcoin does get a pretty nice recovery, then I would be selling some of it or most of it into like stocks and stuff like that as well, right? And you could always do the altcoin swing strategy that I teach. You try to get in at a zone of support, and then you want to set like an exit target at a zone of resistance, right? And of course, it doesn't always work. There's no like investment strategy that always work all the time. So that's something to consider. You always want to like be clear about the risks, right? And again, your strategy could be very different depending on your personal goals. And if we're looking at like providing liquidity long term, in my opinion, it's again more of a risk to like provide, to think about like altcoins as an investment that is gonna survive in the next 5 to 10 years, because we always kind of have to like reevaluate the investment that we're putting in, simply because there's like new projects popping up all the time. For example, like if you're invested in Hyperliquid, it's likely that it's going to retain its market dominance, but you never know, right? There was stuff like Aster that is popping up, and people are just like somewhat concerned about Aster because it's like backed by Binance, right? And then you kind of want to like reanalyze your investment and develop your thesis, kind of like update your thesis over time, right? But for like longer term investment, stuff like Bitcoin is probably not gonna like go away, right? And even with Bitcoin, there could be like arguments of like, okay, is the world actually going to like adopt like this asset, right? Because chances are friends and family, most of them probably don't hold like a ton of Bitcoin, right? Unless you're in like a very specific community that is really into crypto. Most of the time, even like retail altcoin investors, they don't hold a ton of Bitcoin. So you could argue that, you know, maybe it's not going to gain that much adoption. We never actually really know the future, right? So I personally believe in the assets like Bitcoin and Ethereum long term, but then you don't want to put all of your like life saving into it either, right? Because what if you're wrong? And then the price just works like Ethereum, just kind of like stay flat for like the next decade or so, right? You don't want to be in that situation. And then as yield farmers, that's a good thing because, well, not a good thing, but like it's better than just holding in the market, right? Because again, we could be earning trading fees when people are trading these assets. But then there's a lot of management strategy that you guys should be implementing already. Like for example, when prices are cheap, or focus more on compounding fees and then accumulating assets. Because for example, if you are running an ETH to USDC pool, or like this strategy over here. So if you guys go to like Crystal and then hit on strategies, you could actually dive into these like longer term positions here, right? And I've taken a look at like some of these strategies yesterday here, but basically if we look at this very simple strategy and very simple position, you can see that they basically set a range from like $1,000 to $8,000 for ETH to USDT, right? And then they deposited first in 2021 of May, and then I believe they deposit again in October 2021. And then they just keep depositing over time, right? But they stopped depositing for quite a while now. And then they're still able to earn like almost 50%, over 50% on their initial investment. So that is quite good for the return of like maybe 4 or something years or less. And of course, in crypto world, you might think that like 50% is not that good, but you gotta think like, okay, we're betting on like a major asset class, and it's obviously not going to move as much as like, you know, other assets. And of course, your return could be greater if you actually get in at a cheaper price, right? But I just want to show here that even long term, like providing liquidity for these assets, if you are able to think long enough, and like these assets at least move sideways for this whole time, then you could still be sitting at some really nice profit without some like complicated strategy, right? But again, we can boost returns by doing stuff like compounding when the prices are cheap. So if you earn like, let's say they have an unclaimed rewards of 200 something K, right? But if ETH price goes to like a couple months back at $1,500, if you compounded all of your cash during that time, you're basically gonna be forced to like swap some stable coins to some ETH, and then you're buying low, right? And then you're actually adding the capital, dragging down your entry. And then when the price rips back up, you're going to be able to earn more fees and the capital appreciation would be greater as well. So that's a very powerful long-term strategy. And again, it works particularly well for assets that are likely to stick around for the next 3 to 4 years or longer. And then you could also dollar cost average into the market with your other sources of income, right? And this is typically what I recommend too. If you have a pretty steady source of income and you're looking to be a net accumulator, you don't really want to like think about, okay, how can I like maybe live off of DeFi and try to like, try to over optimize the APR too much. What we want to think about is like, how do I actually grow my portfolio and accumulate these assets that are likely to grow in price, right? And then when our portfolio is large enough, then it becomes very easy to live on like investment return. And then if prices are expensive, again, we could always sell our fees into stables or dollar cost average into other asset classes instead of these liquidity pools, right? If you want to, for example, use some of the fees, like let's say you are this person and you've earned like 300K over time, then you could have used that 300K to build your TradFi portfolio or to build your Bitcoin stack and stuff like that, right? So you don't necessarily have to put it all into the LPs that you are running. If you are trying to get a better price when it comes to buying a particular asset, a strategy that I've found to work decently well is we try to dollar cost average in, or like to, let's say you're stacking like cash from your job, but market is like kind of overheated. You don't feel like buying, then you could wait for like different indicators, like for example, the 25 period RSI, right? To drop below like 50. That's typically a good point to start looking at like some buying opportunities. If you're not trying to get the best entry possible, and that is typically the best way to go, you don't want to like wait for like a reversal signal before actually buying, because sometimes price could reverse quite aggressively, right? But at the same time, if you've saved up a lot of cash and you're looking to build exposure, you don't have to deploy everything at once either. Or you could deploy, for example, into that ETH to USDC pool where you're not buying like 100% of Ethereum at this current price point, for example, right? Just because if it dips lower, then you're actually gaining more Ethereum than if you actually bought everything at the spot holding. The obvious downside with that strategy is if prices kind of just wicks below a little bit and then kind of bounce pretty hard, you would miss out on the upside, right? But in my opinion, a lot of times protecting the downside and missing some capital gains is much better than like if you're buying really high and then you're kind of like watching your portfolio draw down too aggressively, right? So that's a strategy that you guys can implement when the weekly RSI is below 50. And then we could start to think about de-risking and then selling a lot of our fees or even spot holdings when the RSI is starting to climb, especially on the weekly chart for a lot of altcoins. I believe that's a pretty solid indicator. Stuff like Solana, for example, you see like that price action, of course, because the previous weeks to the run up to like above $100 in 2024, we actually didn't get a below 50 RSI, right? Of course, no indicator is perfect. So you kind of have to evaluate based on the market as well. And like, for example, you might have been more comfortable buying here, like after it has retested that support level a couple of times, right? That would have been a pretty good entry for Solana. But then if we're looking at the weekly RSI, when prices are breaking new highs, that's a good time to be like securing some profits, right? And some people say like, this is market timing, don't time the market. And I mean, it is market timing in a sense, but we're not actually like forcing it, right? Like you're reacting kind of to the market where if the profit opportunity comes, you're taking the profit. But then if it doesn't come and then it just grinds sideways for a while, let's say your profit target is at around like $200, right? And it just grinds sideways for a while, you're still making a pretty decent profit if you're yield farming concentrated liquidity pools, right? But that's one investment plan for longer term investing. if you're trying to get a better purchase price. And typically you want to not only use one strategy, right? Simply because it could outperform or it could underperform, but we never actually know until the price action happens. So if you're running this strategy to try to accumulate more assets, you might be doing a very simple like DCA either into the liquid pool directly if you're trying to get more cash flow or into spy assets like Bitcoin, right? Like some people say like, hey, if you swing trade and do this, do that, you could beat like a simple DCA strategy. But in my opinion, a very simple DCA into BTC strategy is actually pretty hard to beat simply because especially if the price action of BTC kind of looks like maybe like gold or like the S&P 500 over time, with the halving becoming less and less relevant, it's going to be very hard to like take the swing up and down, right? Because sometimes the swing down might not be that aggressive and then the asset could just be grinding up over time. So a very simple like DCA strategy could actually be a very profitable strategy if you just expand like your investment time horizon, right? Some people would ask me like, hey, it's very difficult to like multiply my wealth when I only have like $10,000, right? How do I actually turn it into $1 million? And usually the answer is like, just keep investing, keep LPing, and then you want to focus on your active income and then like slowly build up your portfolio over time, right? It's more rare for like traders to turn 10K into $1 million than like people who basically blow up their portfolio trying to do so, right? I've been in crypto for quite a while. I've been in like a ton of different crypto communities, different DeFi communities, but most importantly, like stuff like NFT communities and like trading communities and stuff like that. It's not very uncommon to like see traders blow up their portfolio or suffer a pretty big loss because it's just a very hard game, right? And if you think about it, there could be like one big catalyst either to the upside or to the downside at any single time that could like send the market down aggressively or up aggressively, right? So we gotta plan with that in mind. Like the FTX collapse, for example, I would say that like most people did not see that coming unless you were an insider or something, right? And the price collapsing and stuff like that is something that should be in your like mind that could happen. And another example strategy here is if prices are below our entry or cost basis, we start DCAing in and compounding. So this is really good because like you're adding these assets at a cheaper price than what you bought before, right? And then again, if your plan is like net accumulation, you want to have more exposure in the crypto market because you believe in the sector growing for the next 5 to 10 years, then this is going to lower our cost basis, right? And then we could de-risk a little bit when prices are above our cost basis. And you could do this with the DCA strategy as well. Let's say your cost basis for ETH, if you just DCA, since like even the last bull market, right, you would have had like a pretty low cost basis at like 24 or something $100, right? Or like $3,000, that's it. But if price is near like $5,000, you decide to secure some profits. That's always a good thing to do, right? You don't have to like hold everything for the next like 30 years to be able to make money in the market. And then even if you miss out on like some of the gains, maybe you could just, for example, use that profit to like add to your stock portfolio, right? You don't have to like rebuy these assets at a higher price if you believe that they are kind of overvalued, But that's very similar to plan one, where we're doing that smart compounding strategy. Prices below our entry, we compound in, and then that's going to drag down our entry. Price above, we just de-risk out, right? And then there's another argument for like plan three as well, is like, if you're a pretty long-term investor and you're reasonably certain that like the assets you invest in is going to either stay flat or like go up and to the right over time, stuff like ETH and Bitcoin, then a pretty simple strategy to build like your cash flow over time is to set a wide enough range or like set multiple ranges. And then you're just going to take like your income every single month and then just ignore the price and then DCA in, right? But if you're using like a stacked LP setup, let's say you have a bullish range, 1,500 to like, let's say 10K, or like higher, like to the max upside, then maybe you have a bearish range of like, let's say 6,000 to zero. That could be one potential setup that you LP long term. And then what you're going to do in that case is you could adjust the exposure of your LP, right? So if the market is really strong, for example, like ETH is at 6K, but then you don't want to buy that much ETH, what you're going to do is, if you're DCAing in, is to DCA into that bearish pool, right? Because what that is going to allow you to do is like, you're going to be able to automatically accumulate more ETH if the prices dry down. And if price keeps moving up, drifting up, that doesn't even matter either, because you're earning fees in the process, right? You're earning like, let's just call it like 10% APR at least over time. So that's still a pretty good use of your money. And if prices dry down aggressively, you could compound more heavily into that bullish pool, or to DCA pretty aggressively into that bullish pool, right? And again, this is assuming if you are bullish on this asset, and then that this asset has a good chance of like performing well over the next 5 to 10 years. And you have to kind of like analyze that, and then also think that it is possible that these assets are not going to perform that well in the next 5 to 10 years, right? If we look at even stuff like Bitcoin and gold, or Ethereum to gold, you can see that Ethereum has pretty much underperformed gold for quite a long time. And it's very hard to like predict long-term outperformance, right? Because again, the fundamentals changes all the time. But what is really good is you could always adjust what assets you buy with your active income, right? For example, if you're already heavily into crypto already, it's probably not a great idea to like keep building up too much of your crypto exposure, because then if you're wrong about crypto going up and to the right, then you could be sitting in a lot of losses, or like you could be just missing out on a lot of the gains in the other markets, right? But if you are, for example, on the opposite end of the spectrum, you hold a lot of stocks already, you want to build your crypto exposure, you could put like 100% of your income into crypto. And that's a completely different situation, right? And you can always, for example, like put 50% into stocks and then 50% into crypto. If you're like under 30, for example, or like you're comfortable with more risk, then that could actually be a good thing to do. But taking more risk, again, does not necessarily mean like more rewards in the future. It's like potential reward. And you just got to be comfortable with that fact, right? And it could be helpful to have more of a dynamic risk down. Why I prefer this method is because we could lock in more profit and capture more volatility, right? And then you could profit from a wide variety of strategy. For example, I just shared like 3 different strategies that you could run. And of course, you don't have to run all of them. Most of these are passive strategy for like the blue chip pairs. And then we could be running like those altcoin pairs as well, right? Like we're compounding more when prices are cheap. And then when the market is really good again, we could be selling a lot of these positions and then potentially exiting these positions completely as well, right? So you could profit from a wide variety of strategy. The thing about having a dynamic risk out is that you could still be profitable even if you are wrong about like the exact top or the bottom of the market, right? Simply because we're taking risks smartly. And this is what a lot of investors like Warren Buffett says, like, you want to be greedy when everyone is fearful, and then be fearful when everyone is greedy, right? Is that market timing? That it kind of is, right? But you're kind of reacting to the market, what the market is giving you. You're not really like forcing the investment. If an investment feels overvalued, or if there's a lot of euphoria in the market, of course, it makes sense to take some profits, right? And of course, if there's a lot of fear in the market, you're going to be able to find more buying opportunities, right? Because again, the market could feel that like the price is very efficient, is pricing in all of the news. But we got to realize at the same time, the price is actually pricing in the human emotions as well. And we all know like human emotions could affect logic. So the market is not like logical, if that makes sense, right? Because humans are behind that market. So we got to think about that and having a dynamic risk out. So this leads me to the risk dialing, and I'm kind of reorganizing these diagrams. So let me pull up the 1 second here. So I'll share the mind map when it's ready here, but Basically, there's a lot of things that I'm working on behind the scenes. One of the ways that I think about risk is that when there's like an oversold market, of course, we want to try to be as long as we can, right? Meaning that we want to be like buying as much as possible. Yeah, risk. You could be buying protective, not protective, but cash secured puts on risk on hyper EVM as well. And make sure you use Styles referral code. But basically, if you're trying to accumulate assets, the best time to do it is like in an oversold market or in a bear market where there's a lot of fear, uncertainty, stuff like that. But in the overbought market, we want to focus on locking in profits, right? And the way I like to think about it is like, if you're just a very passive investor, you don't really care, you just stay long all the time, right? Don't even worry about like, taking profits until like 10, 20, 30 years out if you're a net accumulator. Of course, that could not work as well for like different assets like altcoins, but it could work extremely well for like more established assets, right? Like the stock market, stuff like the QQQ, you could just stay long and then don't worry about like taking profits, right? And then if you're trying to be more of an active investor, someone like maybe Warren Buffett, people that are trying to like outperform the market, and you can outperform the market, it's just very difficult. But what we're trying to do here in this case is like for a lot of altcoins, especially if the prices are really strong, we want to be less long, right? You could de-risk most of your fees, for example, or sell out of your holdings completely, but you don't want to, again, be like delta neutral or completely into stables simply because you could be wrong about like the market not going higher, right? You want to still have some exposure at least into majors, like for example, ETH and Bitcoin and maybe like Solana, or if you believe in hyperliquid, maybe some hype as well. What my personal strategy is like, if prices move up pretty aggressively, a good ratio is like maybe max 50% stable coins and then maybe some like short exposure. But even with the short, maybe I use like another 10% on the short side. So I'm still net long like 40 to 30% at a given time, right? Simply because if the assets move up aggressively, I don't want to miss the upside. And then it removes a lot of the market timing risk where like, okay, if you basically sell your Bitcoin at 70K, and then if it moves up to like 120K, you're not going to be forced to buy like higher, right? And you want to make sure that when you're selling, you're still having enough exposure of like your long-term price target, right? Let's say you believe Bitcoin is going to go to 500K or $1 million over time. Let's just say you hold like 3 Bitcoin. You might be more comfortable selling like 1 Bitcoin this cycle and then use that to either yield farm with or invest into other assets. And then you still hold your long-term holding amount that you're comfortable with. So this is the less risk way of like trying to dial the risk. If you look at like people like Warren Buffett and Berkshire Hathaway, they typically don't have too much of a cash allocation. I believe their max is around like 30 or so percent or closer to 50%. But what you're going to find is that these people are never going to have 100% cash allocation because again, the market timing risk, right? Prices could be trading in an environment where like you're not going to be able to find like cheap deals, right? So you got to have some long exposure in the market most of the time, in my opinion, unless you're trying to be like a swing trader, right? If you're trying to be a swing trader, then we're looking at this lower side of things, right? You want to basically, they switch from like a leverage long from one side to the other side of like a small short or a heavy short. But I want to be very clear about this is like, let's say you're using the bear leverage strategy. You should never be using like 100% of your portfolio in a bear leverage strategy. The reason why is an asset could go down. The maximum an asset could go down is by like 100%, right? But you got to think about the upside, like even assets like Bitcoin or Ethereum. What's the max upside? There's no like theoretical max upside, right? Of course, you could say like it's not going to reasonably 2x or 3x from here, but we never know what's actually going to happen, right? And this is especially dangerous with like smaller cap altcoins. Is like the price could very easily, because the liquidity is quite low, the price could look easily like 2x, 3x, 5x. And then if you're like heavily shorting these altcoins, it could liquidate your portfolio, right? So this is like a scenario where it could get you into like long-term trouble if you're trying to like do delta neutral into that small short to heavy short area, which is, I don't really recommend this unless you're only using a small portion of your portfolio, right? Like let's say you're using that stablecoin portfolio to be delta neutral or to just line out on Aave, that's completely fine. Or like having a short hedge with a portion of your portfolio, but you're still net long. That is typically a good strategy to try to minimize the drawdown of your portfolio. But if you are like, for example, heavy short with your whole portfolio, or even a small short with your whole portfolio, that's typically not a good long-term strategy. And then if you want to be leveraged long, I would also caution you that you can't really expose your entire portfolio to like leverage long positions. The reason why is because like there could be that flash crash that we saw on October 10th this year, but like different assets like ETH could definitely flash crash as well, right? Just because it hasn't happened yet doesn't mean that it won't. So it's better to like, let's say expose like 20% of your portfolio to leverage and then the rest is just no leverage rather than like you're depositing everything on Aave and then you're like borrowing against that and then you're yield farming with that, right? I know it's quite a pretty popular strategy in DeFi, but in my opinion, it is quite risky if you're using your whole portfolio for that. I personally would not expose more than like 20 to 50% of my total crypto portfolio into leverage. And even then, the crypto portfolio is only a portion of my overall investment portfolio, right? So we got to be really careful when we're using leverage at either the long side or the short side. And again, it makes more sense to do so when the market is trading at the range extremes, right? If Ethereum's price is trading kind of like middle of the range right now, and you're holding onto some stable coins, then it doesn't really make that much sense to be like taking on too much leverage at this point, right? If you want to take out some, then you want to kind of take out a little bit at a time and then maybe like 10, 20% of the LTV rather than like, going for the max recommended amount of like, let's say 30 to 40%. Simply because assets are kind of trading at like middle of the range. Again, it's not really expensive, but not really that cheap either, right? So that's the risk dialing method. And we did go over stuff like the strategy cycling, right? If we kind of go down here, basically the strategy cycling is like the risk and reward for a particular pair kind of like goes up and down like this over time, right? Like if it's very oversold, then it makes sense to use a little bit of leverage here if you're trying to take more risk. Or if like a lot of altcoins are, for example, trading at a deep discount, then it makes sense to be like investing more into crypto to crypto pairs, right? But again, this is not for your whole portfolio. It's only for like a portion of your portfolio in like a specific strategy, right? Let's say you want to deploy 10%, 20%, 30% of your portfolio into a specific strategy. You want to kind of like analyze the market condition and then see like which strategy is actually the best. And then it also matches like your portfolio and like your risk tolerance, right? And then we could also look at the bear lever strategy, right? If Ethereum is trading at, let's say like $6,000 to $7,000, that was kind of near my target of like, okay, I'm more comfortable using this strategy rather than like a crypto to stable pair, right? And of course, the price didn't really reach the target, but a lot of our portfolio, if you've been yield farming for a while, is still going to be profitable, right? So just because like it hasn't like triggered these strategies doesn't mean that you're not going to make money in the market, right? I have a client portfolio that is right now about 190K or so, but they entered the market with about like 150K last year when ETH was trading higher than it is right now, right? So that's still a pretty big win in my book because like you're still outperforming one of the major asset classes, right? Not asset class, but one of the major assets in crypto, which is Ethereum, right? So that is the strategy cycling that you guys can do. And then you could do like pseudo delta neutral as well if the prices are not as aggressive. And again, with these strategies, you want to be running a wider range. Like let's say you want to do the bear lever strategy, but at this current price, I personally would not do the bear lever strategy, but I could be running, for example, the pseudo delta neutral if I believe that ETH could potentially reverse, I could set a range of like a wider range. And you guys want to like dive into the class before you actually deploy. But basically the pseudo delta neutral is going to be slowly shifted to the bear level, right? So that could be a better risk and reward strategy at this current price point. So we should always be kind of thinking about like what is the best risk and reward strategy right now if you're looking to deploy capital. Like for example, I do have, again, the client portfolio, we have about like 20K worth of stable coins that is not into LPs. But basically, if I want to deploy personally right now, and I'm looking at different pairs like E to USDC or SOL to USDC, am I going to go with a leverage strategy? Probably not, because it's not like cheap enough to do so, in my opinion. And then like, if you look at the overall market condition and how Bitcoin is trading, maybe this trend line looks kind of scary if it breaks down. So I don't definitely want to be like over leveraging on the long side, right? So we kind of need to analyze the market to see like what is the best strategy at a given moment, right? And then we could also look at different strategies of using LPs to lock in profits and rebid assets. So this is an excellent strategy to use with some of your spot holdings, especially if you hold a ton of your spot holdings. And maybe you were running the bull leverage strategy on the way up, right? Let's say you were holding Bitcoin on the way up and then you borrowed against Bitcoin. When prices are quite cheap, you kind of rode the trend up. And then you could basically deleverage when prices are kind of like starting to downtrend, right? And then what you could do is sell some of your other spot holdings to lock in profits as well. And then set like a more bearish range or even a neutral range with a 50 to 50% deposit. What that is allowing you to do is if prices basically draw down from your entry, you're going to be accumulating more of that asset, right? In this case, it's Bitcoin. If prices drift up, you're going to still have more stable coins. And again, if you're a net investor, net accumulator, long term, you don't want to use your entire portfolio for this, right? And it works the same way with ETH. If you're trying to net accumulate ETH, then like one strategy is like selling a bunch of your spot holdings at, let's say 4 to 5K into a ETH to USDC pool. Because the worst case scenario is if prices draw down aggressively, you're going to be left with a bunch of ETH in the process, right? And I know people that run a lot of these bid and spot strategy. So what they do is they hold a lot of spot, and then when prices are high enough, they sell and then into like, let's say ETH to USDC. They wait for prices to draw down and then they close their position into ETH once more, right? So that is like a very viable strategy that makes sense. And again, because you're not using leverage, you're not actually going to be liquidated and stuff like that using that strategy, right? And of course, you could use that for different altcoins as well. Like if your altcoin pair is out of range, for example, my panel to ETH pool is kind of sitting near the bottom of my range. If I want more capital gains and I don't mind having no yield, I could simply withdraw my LP, wait for prices to recover at a good price, and then sell all my panel holdings for ETH profit. That also works as well, right? So that is like the bidding strategy to lock in profits. And then what you guys can also do is use a portion of your portfolio as a short only strategy and to balance out the downside, the volatility of your portfolio, right? And then the reason why we want to kind of balance the downside of our portfolio is because if you lose too much value in your portfolio, you could actually lose. It's going to be very difficult to recover your portfolio, right? I'll have to search up the chart in a second, but I released a pretty recent video about reducing the downside risk is because like, let's say you start with 100K and your portfolio draws down to 50K. It's going to take like 100% worth of profit to make that money back, right? Even though you just lost like 50% of your portfolio. But the good thing is like, if you lost 50% of your portfolio from like a drawdown, you could still like dollar cost average in to like ride the uptrend upwards, right? But it's very important to protect like the portfolio drawdown and making sure that you're taking profits again, especially for altcoins, because we see like time and time again, these altcoins can run pretty aggressively, but then it could draw down quite aggressively as well. it's more important to take profits and then miss out on some of the upside, because in reality, you cannot ever capture like 100% of the upside, right? And you got to have like your profit targets in place. I came from the NFT world and I actually spent like a few $1,000s. At the time, it was around like 2 ETH, but 2 ETH was quite expensive at the time. I joined like an NFT trading community. There was like about 1,000 of us. The community ended up not surviving, but basically we were pretty good at trading NFTs. I made a little bit of money. I wasn't as good as the others, but most people who are really good at trading, they take the profits in a systematic way. And then they set stuff like what is the risk that they take, right? Per, per trade. And then what is the exit target that they could hope to get from the market, right? And a lot of times, if the exit target is not at least like 2x for like riskier investment, then it's not really that worth it to be buying at that time. So if we're buying or minting Ethereum, like an Ethereum NFT at like 0.1 ETH, for example, oftentimes our exit target would be at least like 0.2 ETH, right? Because an interesting strategy that we could do is if we buy like 2 NFTs at like 0.1, we could sell 1 NFT at 0.2 to recover pretty much our costs, right? So that is a very interesting trading strategy that you could do with like riskier assets, right? Like, and that's a valid investment strategy as well, is you buy like heavily when prices are cheap and the risk and reward is favorable. And then you focus on de-risking slowly on the way up. And then you could choose to sell everything as well, or you could choose to like, let's say just sell half of your holdings or a portion of your holdings to de-risk. And then you try to buy back into like these assets if you want at a later date. And if you believe that there's still that upside left, right? So that is one way. And then again, you want to protect your portfolio with a short hedge. In some cases, that is another strategy that you can run. And the price never actually reached like my target for a short hedge. So it could be helpful to like slowly build up your short hedge over time, right? Like let's say Ethereum goes up to like near 5K, you could start like short hedging. But of course, that short hedge is going to lose money if the prices go up. But if prices go down, you're going to be making money with that short hedge. And that is going to reduce the drawdown of our portfolio, right? It actually makes a big difference if your portfolio draws down like 35% instead of 50%, because with a 35% drawdown, you don't need as much capital to like recover your portfolio, right? I believe the gains is around like with the 35% drawdown, it's like you're going to be left with like $65 if it's like out of $100, right? And then you only need to make about like 50%, 50 something percent return to actually recover your initial investment. Versus if you lose 50%, you would need a whopping like 100% return to actually recover your portfolio. So that's very important to understand. And that is a strategy that you could run. And this leads me to my next point, which is strategy diversification. So the reason why I've included a lot of strategies in the course is because a lot of times one of the best approach to like have a more steady equity curve, meaning that you don't suffer too much drawdown, is to incorporate a wide variety of strategies, right? And I'm just using examples here, but you could be like switching these around and you could actually adjust this to your own personal scenario, right? But let's say you're using like buy and hold and you did that with Bitcoin, it would have done phenomenally well in this bull run. And maybe for the year, it's not as good because the price has been kind of just like either flat or trending down a little bit. Since like the beginning of 2025, you can see it's kind of flat. So it would not have done as well. So that's why we still want to have like stuff like, for example, altcoin LPs, if you're into altcoins. If you're not, then you still want to have some like liquidity pool, in my opinion, is still a great strategy and probably the main reason why you guys are here, right? But sometimes like these LP strategy is going to underperform these other strategies because we never know what the market is going to do, right? Sometimes the market is just weak. We could do our best to like play with the cards that we are dealt, but we cannot force our hands to like make returns in the market, right? Because that's usually how you're going to get blown up. You're trying to like force a return in a weak market. And that's a way with NFTs as well, right? if the market is really bad and you're still trying to like force a return in the market, a lot of people just lose a bunch of money over time when they're like investing into NFTs simply because the market is just hasn't been favorable for a very, very long time, right? Maybe the technology would be adopted in the future. Again, we never really know. Like back then, people are saying, NFTs are the future, right? So we gotta be realistic. And then in a sort, it is a little bit better to be like a pessimist in the crypto space than to be overly optimistic. Because if you're overly optimistic, you might be like too trusting of these teams. And then like you might not be doing the due diligence that is necessary, right? And then again, you want to be doing stuff like dollar cost averaging stocks. And then if you are a swing trader, you could incorporate that strategy as well. But that is not really as easy as it seems either, right? The average retail investor is going to look at a chart like Ethereum and just say like, hey, what if I just like short it here? Or if I just longed here, I would have made much more money, right? Why do I even LP? But in reality, they're not disciplined enough to hold through like the wild swings of the market. And also when you're swing trading, you typically cannot use like your entire portfolio to do so as well. And unless you're using like a stop, but even then there's a lot of risk that is associated with it, right? So your actual return is not going to be as high as what people make it out to be, because like hindsight again is 2020. I could always like measure the gain from here to here. That's 200%. If I just had 100% stablecoin, I buy this and then sell here, I would have like doubled my portfolio, right? And if you guys have been around for a long time, you would know that things are not that simple. And that's why like I also advocate that if you're using like 1 to 2 active income strategy, you typically want to get really good at it first before you try to like spread yourself too thin, right? If you're just diving into LPs, you want to make sure that you understand everything that I present here and what I teach in the course. And of course, you could adjust the strategy as well. You want to make sure you understand things before you tweak things. And that's like the main thing why I've been able to develop pretty good strategies is because I understand that like you want to be a learner, right? Like a forever learner. I understand that my strategies are probably not perfect. There could be improvements to be made. And that's why I'm developing new strategies as well, right? Like the stacked LP where you have what I described, right? One bullish LP and then one bearish LP that is allowing you to adjust the market exposure depending on where the prices trade at. And then also giving you a net higher APR than like a full range LP or like a specific LP range. You could run this setup as well. Like let's say this particular range is 1,000 to 8,000. That could be like a potential more bearish range, or you could set like, let's say 500 to 8,000. And then you could set another range that is at like, let's say 1,500 to like 20,000 or something like that, right? And then you got to run like the simulation for each separate LP. But basically that's the idea behind like the strategy diversification and stuff like having a job and even running a business. Sometimes there's going to be good times and then there's going to be bad times, right? And you got to be prepared for that. And then you got to actually have enough cash to survive like the drawdowns, especially if you're like more active into altcoins, but I believe that is pretty much it. Yeah. So pretty long workshop so far. Any questions about any of this? But basically like sometimes one of the best strategies is just to keep things simple and then you're investing for the long term on some of these assets. But again, a lot of these altcoins do swing pretty wildly. And then it does make sense to like take some profits when the opportunity comes, right? Yeah. If you guys have any questions, now is a good time to ask. And I'm liking Crystal so far, and they've been like making some changes, but right now it's one of the best tool to be like filtering for a lot of these DEX platforms. And Metrics Finance works really well too, but it is a paid tool. And we are developing some stuff in the Drippy Labs. Cornelius is building us some stuff, but that could take a while. But we have to kind of build something that has like product market fit and then something ideally that no one else has either, right? We'll probably have some features that other people have, but we're looking to build something that maybe other people don't have yet. And then if you guys, it would help us a lot too if you have any constructive feedback on like the course, the workshop or anything. you could always leave it in the feedback select section or open a support ticket. That would help us to like improve the experience of the course and everything like that, right? But yeah, my goal for Drippy is just to help as many people as possible that are into DeFi to, learn about stuff like investing and risk management and stuff like that, right? Sometimes like YouTube might not be like the best environment to learn simply because, sometimes you could get like these concepts pretty wrong, right? Even though I'm giving you the information, if you're not able to ask questions and stuff like that, it could be, if you misunderstand something, it could be pretty financially catastrophic, right?
I have one question, Richard, and thanks. I
Yeah.
think this is great stuff again. How does Crystal compare to metrics in terms of like researching expected APY, or is there any other benefit to subscribing to metrics?
So the biggest difference, in my opinion, is its ability to change like, okay, what is the price that I want to simulate at, right? So if I'm looking at like different pools here, let me try to find one. The APR crystal estimate is actually like where the current price is. The estimate could be quite inaccurate simply because let's say the price is trading at like a low concentration value, but then it's only temporary, right? So then you cannot really adjust
I see.
this line. Yep. So that is the major difference. But it's not a big deal if you're like sticking with most blue chip pairs. And I didn't use metrics for a very long time. And then I did completely fine, right? So it's not really like a necessary tool, but I do recommend it if you want to use some of the paid features. Like one of the best features, in my opinion, is simply that like you could adjust this custom price, right? And you could see like, okay, the worst case scenario APR is around 15% if the volume stays constant, right? At let's say 60 days.
If you move it to the highest
Yeah.
place, then you can,
Yeah.
the worst case. Got it. Okay. That makes sense.
And then you can move it to the low concentration too and see like, hey, what's the best case or a more realistic case, right? Like for example, here, maybe that's the APR that you would be getting temporarily before the liquidity adjusts, right?
Yep. Got it.
Yeah, no problem. But yeah, you could always look at like revert finance for like to estimate the historical APR as well. But the downside with revert is you can't really see on like a lot of these other chains, right? And I think you could do the same strategy with Crystal as well. You try to stock like different wallets on like that same pool to see if, what's the actual APR these positions had been getting, right?
Okay. Thanks. That's helpful.
Yep, no problem.
And I like the risk, not curve. I forgot what you called it, but I like that. I feel like I need to put all the different strategies, plot that onto that, and then put on my wall or something. Make sure to assess before I enter. It's good stuff.
Yeah, the risk down. Yeah.
Thanks.
Thank you. Yeah, no problem. All right. Thank you guys for coming. I'll
Thank you.
catch you guys inside the Discord. Thank you. Thanks, Austin. Thanks, AJ. And Styles too. Thank you, love. But see you.